Good evening and a warm welcome to all of you joining us from across Europe, North America, the Middle East, and India. My name is Coelho from Nuclear Business Platform, and on behalf of NBP and our co-host EY-Parthenon, thank you for making the time to be with us today. We have a busy 60 minutes ahead, so I'll keep my welcome short. Today we are going to do three things. But before that, allow me to put on my slides and we can then continue on. So allow me to share my screen. So today we are going to do three things. First, I'll take about 10 minutes to set the strategic context, what the SHANTI Act has actually done to India's nuclear energy sector, why we believe this is the moment for international firms to be paying very close attention. Then I'll hand over to Kapil Bansal, partner at EY-Parthenon India, who will walk us through the financing landscape that is emerging in this post-Shanti environment, capital structure, tariff economics, and where the international capital fits in. Then over to Hiten Sutar, partner at EY's India's tax and regulatory practice, who will cover market entry pathways themselves, entry vehicles, IP licensing, cash flow, joint venture structures, the practical questions any international firm has to answer to come into India. And we will close with an open discussion and audience Q&A. So please drop your questions into the Q&A panel as we go. We will pick them up in the last 20 minutes. Two quick housekeeping notes. This session is being recorded and the recording will be made available to all participants afterwards. You're on mute by default. Please use the Q&A function rather than the chat for questions you want to be addressed by the panel. With that, let me start with the strategic context. For those of you who do not know me, my background is 20 years in this sector, the last 7 of them building the Indian Nuclear Business Platform from its first edition in 2018. Across those 7 editions, I've heard the same questions from international firms time and time again. When will India's nuclear market actually open up? International vendors, EPCs, technology developers, investors, all watching India's nuclear program from the outside, knowing it would be massive when it came, frustrated that participation was largely closed to them. In December 2025, that question got answered. India passed the SHANTI Act in December 2025, and to my mind, this is the most consequential piece of nuclear policy legislation India has put through since the program began in the 1950s. 3 things SHANTI did. First, it capped operator liability. Nuclear liability had been one of the principal sticking points for international vendors looking at India. The earlier framework left vendors and operators uncomfortably exposed until the 2010 Civil Liability for Nuclear Damages Act. SHANTI has now ring-fenced that exposure into a clear, capped, insurable regime. Second, it opened the market to private operators. For the first time, Indian industrial conglomerates are now authorized to fund, build, and operate nuclear assets for captive use. This is genuinely without precedent in India. And third, and most relevant for many of you, it permitted foreign equity participation of up to 49% in new build. Direct equity participation, not just licensing, not just supply contracts, actual equity in Indian nuclear projects. These 3 changes together do something none of India's previous nuclear reforms have done. They create a structurally investable, internationally participable market. And the numbers underneath these policy frameworks are serious. 100 gigawatts of installed nuclear capacity by 2047. That's India's stated national target. To put that into context, India today has around 8.2 gigawatts installed. So we're talking about a 12-fold expansion in roughly 2 decades. USD 214 billion is the estimated build-out value. And that is across reactor build, fuel cycle, services, supply chain, balance of plant, the full ecosystem. And the 49 foreign equity cap I mentioned, is the structural opening for international capital to participate directly in that build-up. Now, if you triangulate the policy intent, the budget commitment, India's nuclear energy mission has been allocated roughly $2.3 billion, and the structural opening to private and foreign participation, you have a market that has gone from being effectively closed to being one of the most concretely accessible large-scale nuclear opportunities anywhere in the world. One specific element I wanted to flag, because it is part of the SHANTI framework least well understood internationally. The Act creates a new private user category, Indian industrial conglomerates authorized to fund, build, and operate nuclear assets for their own captive industrial use. The first cohort named under this framework is significant: Adani, Tata, JSW, Reliance. These are all India's largest industrial groups collectively, with hundreds of billions of dollars of operating assets, deep balance sheet, strong engineering capability. For international firms, these changes who you are talking to. India's nuclear customer used to be a single counterparty, which is the state-owned operator NPCIL, Nuclear Power Corporation of India Limited. Now you have a half dozen sophisticated, well-capitalized industrial counterparties that have signaled publicly that they intend to build their own nuclear procurement programs. Adani has confirmed its nuclear business group. Tata Power is publicly setting out its nuclear roadmap. JSW, Reliance have all moved. Several of these companies are represented as key speakers at INBP 2026, with Adani and Tata Power being key partners of INBP 2026. And the conversations happening on the floor at the conference are increasingly between the new private users and the international supply chain. So what does this practically mean for the people on this call? Three things. One, positive positioning windows are closing quickly. India's nuclear program has historically been state-driven, slow, and methodical. Post-SHANTI, it is fast, multi-counterparty, and procurement-driven. Firms that moved into the commercial conversations now, over the next 12 to 18 months, are positioning themselves ahead of the curve. Firms that wait will find their international competitors already in the room. Already, we are seeing massive trade missions taking place in India. Last week, the US government brought a delegation of around 20 US companies for high-level meetings with Indian nuclear stakeholders. At the end of the year, we are expecting countries like France also having trade missions. So many countries are already acting fast, trying to position their countries' companies to the Indian market. Two, the financing question is genuinely in play in a way it was never before. Now, Kapil will go deeper on this in a moment, but the simple version is India's nuclear has been state financed for decades, with private operators in the picture and 49% foreign equity permitted. The capital stack is changing rapidly. Third, market entry isn't theoretical anymore. It's structural. Joint ventures, IP licensing, technology partnership, equity participation, supply contracts, all are now genuinely accessible. Hiten will get into the practical structures shortly. Nuclear Business Platform has been convening this conversation for international firms since 2018. 7 editions in India, over 2,000 participants, many MOUs signed on site across editions. We are intentionally a neutral platform, not a vendor, not a government, not a sector lobby. The room is built for conversations between India's nuclear establishment and the international firms that want to be part of it. INBP 2026 takes place on the 16th and 17th of June in Mumbai, 3 weeks from now. By virtue of timing, it is the first major convening of the sector since the SHANTI reforms became law. You will be in the room with leaders from across the Indian nuclear supply chain. 8 closed-door sessions covering policy, the Shanti Bill, new entrants, international collaboration, supply chain, SMR, and financing. EY-Parthenon is anchoring the keynote financing session, and that is directly connected to what Kapil is about to walk us through. If India is on your strategic agenda over the next decade, this is a room to be in. With that, let me hand over to Kapil. Kapil, over to you. Take us into the financing landscape post-Shanti. Kapil, please.
Right. Thank you, Zaf. That's quite encouraging. So if I can share my screen quickly and let me know once my screen is visible. Unfortunately, it's not allowing me.
Let me.
Would you be in a position to share? No,
yes, I will try. I will try from my side.
Yeah, please. So while the screen comes in, quickly, in terms of the Indian financing sector, we're going to talk about, how the impact of the Shanti Bill is, resetting the overall ambition for opening the market competitiveness. The details would be just showcased by, Hiten overall. If I go to the third slide, please, Hiten. Thank you so much. Yeah. So what we're going to do is kind of talk about how the India's nuclear reset is happening with the whole Shanti bill and opening the participation with some of the things that is happening, how the global players are entering into this space to create the overall value chain in the nuclear. Why India is in an advantageous position because of our own Bharat small reactors, the low cost engineering and the modular deployment, creating an attractive scale up opportunity, and then getting into the financing playbook, how you can calibrate a risk return models to unlock the capital which is needed for the nuclear projects at a larger scale that we are talking about. So that's what we're going to touch base during this discussion. Obviously, a quick round of introduction myself. I lead the practice called Systenomics and Energy Transition, and nuclear is becoming an important subject with most of the discussions we are having with these key corporates. So now moving into a quick snapshot, why nuclear has gone into a reset. Obviously, it's one in the lifetime opportunity that we are seeing in a generation towards the Indian nuclear landscape, which was been there predominantly. If you look at most of the reactors are running more than 25 years. But what has changed to modernize the overall nuclear reactors and the pathways towards global participation is the 20,000 crores of R&D budget that has been allocated in 25-26 budget, which is one of the largest civilian nuclear budget that has been provided in India. The act which provides what quickly Zaf talked about in terms of replacing the old 1962 Act, ending the state monopoly and making it open for the um, overall value chain providers and the ecosystem players, whether it's equipment manufacturers, plant operations, the fuel value chain activities to the private firms. We'll just touch base upon how this act is going to open up for the various sectors because that's where the capital will come into. The growth which has been envisaged and our Honorable Prime Minister has also talked about from 8.9 gigawatt to 100 gigawatts by 2047. That's a tall task. And I wanted to bring this picture because when we talked about 5 years back on 500 gigawatts in the Glasgow, today we are actually, achieving almost 50% of it way before the target. So once India takes some certain targets, currently it's getting achieved. And then obviously we talked about the equity infusion that is going to happen in the space from the foreign liberalization towards the 49% in the Indian incorporated JVs. Details Hiten will talk about. Moving to the next slide, if you look at, it's a quite busy slide, but obviously what it leads to is it helps in terms of private sector and international participation. The then there is modern licensing safety framework. The regulation of nuclear and radiation uses have been clarified and established in the Act. Boost to research and development, strengthening the nuclear liability and compensation systems, which was the major challenge in the overall previous bills. Statutory empowerment of the nuclear regulator, enhance the security, safety, and emergency preparedness, and the dispute redressal mechanism. All of this has bring the sustainable harnessing and the advancement of the nuclear energy for transforming India. The Shanti Bill creates the strategic imperatives for us to focus upon the nuclear sector. If we move to the next slide on where that investment would lead to. So the key part that we talked about on the second and third bullet was around how as a generation of 8.5, which has been constant from last 3 years, you're looking at a 92 gigawatts addition in just next 2022 years. So obviously that is driven by the R&D funding, the legislative reforms, and now how this growth will take shape is also now driving the factors towards the investments. So if we move to the next slide, what you will observe is that there has with this bills and this investments, there has been lot of global growth which has started and partnerships that have started building. NTPC and L&T has entered into a partnership with Clean Core Thorium Energy, which is building the thorium-based reactors. Obviously, India carries world's 30% of thorium. So thorium is something that has been missing since long. So that is going to be a good area to look into. Then from an intergovernmental perspective, you'll see a lot of removal of institutes for US restriction list, which was there post the Pokhran program event. And that's where it creates a greater collaboration now, which will help in terms of establishing the BSR facility. And recently, if you have seen the stage two reactors, which will build the auto generation of the fuel on a continuous basis, it itself talks about how this removal of restrictions has helped in terms of greater collaboration. Then obviously we have India, France, India, US, India, Canada collaboration working on different aspects, which then establish the global interest, and that's why this becomes an important forum when we meet on 16th and 17th to bring how this global forum interest can be increased in the Indian context. And then if we move to the next slide, where I want to spend the time is like with the whole global entry pathways, the Shanti BRICS actually Act opens 4 out of the 8 value chain strategies for the private player, participation. Because depending upon the risk and return profiles, the financing would move accordingly. So if you look at the fuel fabrication, the plant construction, operation decommissioning, and equipment manufacturers is completely open for the private sector. The three are partially restricted, which is the fuel mining and import possession and acquisition, fuel reactor design, and the waste management side of the things. That is partially and conditionally through the regulatory. We have to understand what is allowed and what is not allowed. And obviously, the fuel reprocessing is completely restricted with the state entities. Given this picture, which was very different what earlier it was, brings a lot of private interest into the overall sector. And that's why the other one on the regulatory freedom, second is now looking at the cost competitiveness. Now, if you move to the next slide, what you will observe is an any global entrant who enters into the Indian side of the things, BSR provides a very low capex pathway to accelerate the overall deployment at the scale. So when you look at some of the examples from the global experiences, India is anywhere between 25 from a Korea to 88% cheaper from a global technology standpoint of view. That's why we are very cost competitive, and our priorities changes with the cost competitiveness from the private player perspective. And that's where it becomes a very compelling low capital entry point for global participants. And also at the court position, BSR offers an international entrance, a rare combination of modular deployment, lower upfront capital investment, and a potential scale up. So at a $1.8 million per megawatt, when you compare with the heavy pressure water reactors, which are existing across the country. It's again similarly in a very competitive range. But why would it be important for a global entrant? Because this BSR provides a scalable platform for from the perspective of um, CNI customers. So today, a lot of renewable has been adopted. Renewable energy is adopted because again it is scalable, modular, and a low cost. So from that perspective, this will bring a complete cost competitiveness, long-term base load factors, as well as a lowest cost of electricity at the point of consumption. And that's why this CapEx benchmarks are the important factor before we get into the financing mode. I'll just touch base, given that paucity of time, on what are the different financing options that are there for a nuclear portfolio kind of thing, which is in the next slide. So we looked into bill providing leeway into the regulation, cost competitiveness. Now, for any global entrant to enter into Indian market, there are 6 different ways through which the financing in a manner which can be done in a calibrated risk return models. What you see on the left-hand side is obviously sovereign balance sheet, where you form a JV with the state entity or a government-backed entity like NTPC. And this funding comes at the lowest WACC, better debt access, better bankability. But still, there is a flip side, control returns and role depends upon the JV terms and approvals that you have built through. The second is the government to government and export credit agencies backed, which is where again the foreign OEMs, equipment manufacturer, technology providers can enter into the space, but that needs some kind of bilateral framework with the government to government support. Again, it's in the similar range of lowest cost of financing, but then this needs some amount of understanding on a good G2G basis. The development bank backed will also help the same set of people, but this model definitely provides concessionary debt guarantees, low cost financing overall, better debt access, and low WACC. But we need a proper safeguard and compliance mechanism that once this has been utilized, it generates the returns. The fourth is the regulated asset base, RAB model. Again, this comes from the sector of pension fund, insurance, sovereign wealth funds, long duration, patient infrastructure investors. This allows for the factors of cost improvements, low cost construction period during the time when the revenues are not being generated, and overall lower WACC, and comes under the overall regulatory framework that we have to see, for which Hiten will talk from a tax standpoint of view. But then this provides the private sectors to enter into India with a medium risk factors and highest returns. Cooperative models are being worked upon when you're looking at industrial clusters, where all the buyers, off-takers come together, ensure that the demand is being secured, reduces the merchandise risk factors on the banks or the financial institutes who are coming together. But we just need to see from the recourse standpoint of view, the credit worthiness of the person who is taking the offtake agreement. And then finally, which is always known to individuals, are the corporate or the IPP equity structure, which is kind of 26-74%, which we see as group captive open access. Everybody can enter through this, which has the highest strategic upside, a captive platform structure, but comes at a higher cost and higher risk exposures and the exit risk factors. So when we look into the financing, these are different mechanisms. When we'll come to the 16th and 17th of June, we have a session and we're going to talk about with some of the financing institutes about how these mechanisms can work. What are the pros and cons of it? We'll talk to some policymakers, agencies, with industries members to bring about what is the right mechanism, maybe one or two put together to take that thing forward. So in a nutshell, these are some of the financing options, given the cost competitiveness, regulatory openness, and looking at the risk and return profile. With that note, thank you everyone. And if you have any question, come back to you on later stage.
Thank you very much, Kapil, for a very insightful presentation. We'll take questions at the end after Hiten's presentation. So for now, let's introduce Hiten. Hiten, over to you. You can share your slides and you can proceed. Thanks.
Thank you, Zef, and thank you, Kapil, for such insightful presentation. I will just present my slides. Just one second. So as we all know that atomic energy in India is a regulated sector. And to understand what type of structures the international companies can see, it is necessary to see the restrictions which are there in the Shanti Act, as well as the restrictions which are in the foreign direct investments regulations, as well as any other circulars which apply to the players in the industry. So if you see Shanti Act, under Shanti Act, the unit in India can do certain specified activities. But in terms of eligible licenses, we can see that the activities which are prescribed under Shanti Act can be carried out only by government departments or a government company or an Indian company or JV of any of the aforesaid which are mentioned there. So basically, Indian company is the only structure which is permitted under the Shanti Act. No other structure such as LLP, branches, or any other form is permissible under the Shanti Act. So when we are looking at India investment as a strategy, then Indian company or JV is something which can be considered in terms of regulatory provisions. And if you move ahead, again under Shanti Act, certain activities are permitted and certain activities are not permitted. Kapil mentioned those activities, but those are mentioned here on this slide. So for license activity, construction and operation of nuclear power plants is permitted, fabrication use of nuclear fuels is permitted, procurement and supply chain participation is also permitted. So those are the activities which they can do. And certain activities are reserved for government only. So the private players cannot undertake these activities. I will just move on. Now, in terms of foreign exchange regulations, atomic energy is still mentioned in the FDI policy as a prohibited sector. And what we understand based on publicly available information as well as discussions which we are having with certain counterparts, the government may permit foreign indirect investments up to 49%. So there is a possibility that they may come out with a circular. Again, here it is necessary to see that what the circular talks and what if there are any conditions which are there in the circular. So once the circular is out, definitely we will share those details with you. But it is expected that the government may come out with a circular shortly. So for the activities which are there in the Shanti Act, the FDI circular is anticipated. And there has been a circular from Department of Atomic Energy, where it is mentioned that there is no restrictions on FDI for manufacture of equipment and provision of supplies for nuclear power plants and related facilities. So the any supporting activity which is necessary for the nuclear sector, like manufacturing of equipment which are required in the nuclear sector, or providing supplies, or any facility to the nuclear sector, where there is no foreign direct investment regulations, and a foreign company can invest up to 100% in those entities. So two things to note here: 49% for restricted activities and 100% for unrestricted activities. But for 49%, we will have to wait for the FDI circulars. However, for certain foreign companies which are providing IP, or they are providing EPC services, or they are providing a certain technical services, there is no need to have a direct for Indian subsidiary, and they can either work directly with Indian company by not setting up a presence in India, or they can also work in India through a project office mode. And and for doing this supporting activity of either EPC or providing any construction activity, there is no prior approval required for project office in India. Now here we a word of caution. Now both the FDI regulations as well as project office regulations say that if you are coming from a land bordering country of India, then you require a prior government approval. So this discussion is with a word of caution that if any of the service provider is coming from land bordering country or FDI is coming from land bordering country, a prior government approval is required. So that is a mode of investment in the nuclear entities which are there in India. And also these entities can be funded, also Indian entity can be funded through external commercial borrowing. And recently the government of India has revamped the external commercial borrowing framework. And there the borrowing limits has been enhanced, which is either $1 billion or 300% of net worth of the borrower, whichever is higher. And also there are no restrictions on the interest payments which are there on the external commercial borrowings if they are meeting the arm's length conditions for related parties. So that is a good framework which is there. So in terms of doing operations in India, we can see FDI, we can see external commercial borrowings, and also unincorporated presence is something which is permissible. Now, if we go ahead, we have just taken 2-3 case studies, and we open to discussion for any detailing in these case studies. So if we see there is a foreign entity in India who wants to have a stake in JV company in India, then FDI is permissible, which we discussed earlier. Also, there is a capital structuring which is permissible, whereby the capital structuring can be done either through equity shares, preference shares, convertible debentures, loans, or external commercial borrowings. But here again, a word of caution that any convertible instrument which we are using which we are thinking for this purpose, they should not have any conditions by which the control is exceeding 49% or the voting power exceeds 49%. So the use of funding instruments also should be done with a view of regulatory restrictions in mind. And also, while this different modes of funding as are seen, also debt is something where there are no restrictions and it can be used for an optimum advantage with respect to India operations, because the Indian company gets deduction for the interest which is paid on the debt. There are certain thin capitalization rules which are prevalent in India, but if the structuring is done in the right mode, the interest can be utilized to the best possible manner. Also, in terms of investments, the equity and debt can be structured in a way so that there is an optimum capital mix. Equity can be infused when the development phases begin, and subsequently when the construction is nearing, a debt can be used so that there is an optimum use of funds. And also in terms of ECB regulations, if the company is in certain specified sector, then the minimum period required for repayment of external commercial borrowings has also been decreased considerably. So this is something which can be considered. Of course, the Indian joint venture is taxable at a rate of 25.1%. There is no further concession with respect to taxation of Indian entity. And whatever profits they make, there is a compulsory contribution of corporate social responsibility of 2%, which the JV company in India can decide for doing activities which is relevant for the corporate social responsibility in India. The foreign company can take the return from India either in the form of dividends or interest on the loans or royalties or fees for technical services. There are different rates prescribed under different treaties. So the India taxation is generally 21.84% for all of the items which are mentioned. But treaties can take it to 15%, 10%, 5%, or 0% in the case of royalty or FTAs if the jurisdictions are proper. So this is a base model which one can consider with respect to investments in India. And if you go into certain different model, which is called platform JV model, then the foreign companies can also consider the model of having a platform JV outside India in a jurisdiction which is a tax efficient jurisdiction, which provides benefits of a lower rate of taxation on either dividends or fees for technical services or royalties. Or they also offer capital gains exemption with respect to transfer of shares. So in this model, you can see there is a platform JV which is outside India. The funding can be done by foreign entities, or Indian partners can also be a part of that platform JV. And then the platform JV can in turn make an investment into India JV partner. This is a very popular structure in the renewable sector, whereby platform JVs are set up in good jurisdictions. And again, it provides a lot of flexibility to foreign investors to come in and move out, and also new investors to come in. So this is also something which is a model which can be considered. And a variant of this model, which is in the next slide, is having platform JV in India. So instead of having a platform JV outside India, a JV can be set up in India, which can also undertake certain operational activities, and they can hold investments in Indian SPVs. And in future, one can look at monetizing of this platform JV by going to IPOs. Or also think of having a GIFT City entity as a platform JV, whereby tax holidays in GIFT City can be explored. So this is also an alternate model which can be considered. And if we go further, so those are the models which we discussed, which are typically used in different forms of investment in India. But if you are a service provider and if you are having technology partnership or technology supply chain, then there is no need to have a project office in India unless the stay in India is for a longer duration for executing the project. So if you don't require stay in India, you can directly have a contract with the nuclear licensee company. There are no restrictions as of now with respect to the percentage of royalty payments which has to be paid. In India, long back there used to be a restriction on the percentage of royalty which could be paid with respect to foreign IP licenses. But those restrictions are not there in now. only arm's length pricing is required to be done with respect to the use of technology. And also with respect to project office structure, the foreign companies can have a project office in India. But here in this structure, the taxation will change in the sense that this project offices are taxed at 38.22% on their net profits. And they also have to make a CSR contribution. So these are two different models which are there in India. And also if there are offshore supply of goods or offshore supply of equipment for the contractor in India, a structuring is required to do with respect to the such supply of goods, so that there is no trigger of taxation in India. And this is also something where recently there have been some litigation which we have seen with the Indian authorities. So proper treaty analysis is required to be undertaken with respect to these activities. And also one interesting thing is that the SHANTI Act permits the patentability of the inventions for peaceful nuclear energy purpose in India. So now the Indian licensee can also apply for patent. So IP structuring can also be seen that where the IP is required to be put with respect to the Indian operations. So these are the different models which are there. And I will now hand over to Zeph to continue the discussions. Zeph, this was it from India entry and structuring perspective.
Thank you very much, Hiten, for your presentation. It's very concise, very detailed. I hope you guys all were busy taking down notes. I know I was struggling a little bit, but I guess that's why we have the recording for. But thank you, Hiten and Kapil, for those very insightful presentations. And with that, I would say thank you everyone, and particularly thanks to Kapil and Hiten. I think that was an extraordinary rich hour. I think every one of us took away something we did not have when we joined 60 minutes ago. Three things I would like to leave you with. First, the macro is real. India's nuclear sector has structurally opened, and the policy intent is backed by a US 2.3 billion in central budget commitment. This is not a paper market. Second, the financing landscape is genuinely changing, and Kapil has shown us that the capital structures emerging in this market needs to be understood now, not after the first projects close. International capital that engages early shapes the rule. International capital that engages late accepts them. Lastly, market entry is no longer a question of policy access. It is a question of structuring. Hiten has shown us that the practical work, entry vehicles, IP, tax, cash flow, joint ventures, it is what separates the firms that will be commercially successful in India from the firms that simply have a logo on a website. So how do you engage from here? Now, IMBP again takes place in Mumbai on the 16th and 17th of June. As I mentioned earlier, it is the first major convening of the sector since the Shanti became law. You will be in the room with key figures across the Indian nuclear supply chain, right? And EY-Parthenon, as our nuclear financing partner, anchors the keynote financing session. So if you want to attend the conference, please email me directly at zaf@industry-platform.com, or you can visit our website. I believe I've dropped the link in the chat box already. In early June, as I mentioned earlier, together with Hiten, we will release a short pre-event point of view document together with EY-Parthenon on market entry into India's nuclear sector. Lastly, the webinar will go to all registrants, participants, and the POV, as I mentioned, will be emailed to you guys. So once again, thank you very much to Kapil, to Hiten, to EY-Parthenon for joining me today. To all of you for taking your time, and we look forward to seeing many of you in Mumbai in 3 weeks' time. Good evening, good afternoon, good morning, wherever you are in the world. Take care. Bye-bye.